What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring to all of you this afternoon. So what we're going to be covering in this video is a brief Ortex short interest and utilization update to kick it off. Now, what's important about this is that we've seen the short interest numbers continually increase. Same thing with the utilization over the last couple of weeks. Now, the fact that the utilization in short interest is continually going up, once the utilization gets to those high enough levels, 95, 98, 99%, it really puts the pressure on these institutions who are lending out shares and the institutions who are shorting AMC. It makes it a lot harder for them to get their hands on more shares to try to push the price of the stock lower. Now, in addition to this, next week is a monthly options expiration date. Typically, what we see surrounding those dates is a higher open interest and volume on the option chain. What this leads to is a higher potential for some more volatility and even, must I say, a gamma squeeze coming throughout the next week. Now, again, gamma squeezes can happen in the upward and downward direction, and we're going to take a look and see exactly what those price levels are and how we could potentially get there. Now, in addition to all of that, we have been talking a lot on this channel about the fact that a lot of these key players who are most likely shorting AMC are wildly over leveraged on a variety of different situations. The fact that they are over leveraged, we have a lot of very important economic events coming at the end of Q3 and in Q4. We've been talking about that could be around the time where we start to see the liquidations and the deleveraging of a lot of these different positions. We are finally starting to see the signs of that now, with a couple of key institutions really being the first ones. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So when we're looking at the chart of AMC, again, we had a green Friday. That is something that we have not seen for a very significant amount of time. I believe the last time that we saw a green Friday was at the beginning or middle of June. The fact that we have finally saw one of these green Fridays is a great sign because this sends more call options in the money and it could potentially lead the way for more buying volume at the beginning of next week. Now, coming over to Ortex, we can see that the utilization is currently at 92.56, but with the amount of borrowed shares on Thursday, it was about 13 million shares. I would expect to see that utilization number continuously go up. Me and TMI were kind of talking that the utilization could end up at 95% by the end of this past trading week. Now, we saw a lot of shorting, we saw a lot of shares go out on loan, but we did end up seeing the utilization go down. An explanation for this could be the result of the institutions finding more shares to lend out, which gives the shorters more ammo. But at the same time, they're basically just still kicking the can down the road, delaying the inevitable, than the fact that they are going to have to cover their shorts. Now, when we come over to Stonko Tracker right here and talking about this potential gamma squeeze, when we're looking at the call options in the money and the puts in the money at the current time, we have 43,000 calls and 54,000 puts. When we look at those two numbers, the amount of hedging that the institutions are going to have to do are going to outweigh on the put side. And in order to hedge those puts, you have to go out and short the stock. But when we come over to the actual options chain for AMC, we can see that 34, 35, even 38, all the way up to 40, there are a lot of contracts at these given strike prices. And what that allows for is more institutional buying volume in order to hedge these options. So that could add fuel to the fire for the price movements next week. But again, the main thing that we need to think about is that all of these options are most likely going to lead to more volatility. Now, let's get into this over leveraging situation and how a lot of these institutions are starting to liquidate a portion or even a significant portion in some cases of their portfolios, mainly onto retail investors. So when we come over to this tweet right here from Unusual Whales, in the Fed's recent minutes, they noted that hedge funds are historically more leveraged now than they ever have been before. Now, we've talked about this in the past, but this came out on July 10th. Nothing has really changed since then with the amount of leverage that the institutions are having right now at the current time. But One thing that has changed is this right here. Margin debt in the market down 4.3% in July, and this is the first decline in 15 months. Now, this does represent a lot of the institutional margin, but it's a little bit strange that this number is not higher due to the amount of derivative exposure that a lot of these institutions have. Now, something that I want to point out to you guys is that we are suddenly seeing a downtick in the amount of margin debt. So we've seen the margin debt go really, really high over the last 15 months, but this is the first time it's come down. Look what happens to the S&P when the margin debt really spikes up and starts to come down. The red line right here is the margin debt, and the blue line is the S&P 500. So we see the spike up, and the margin debt starts to basically come down before the overall market has its sell-off. So this could be a sign of things to come, and the fact that everybody, we know they're over-leveraged, and we are seeing the margin debt numbers start to decrease. It could be two things. One, it could be institutions liquidating and selling off their positions in order to have these better leverage ratios. Now, the second thing is that they could be getting margin called at the current time. Now, let's go over the first explanation of this, the deleveraging of portfolios by liquidating other positions. Now, when we come over to this specific article from Zero Hedge, so unlike other banks who have rushed to hike their S&P forecast as the market has ground higher, now, what they're referring to right here is Goldman Sachs increasing their price target for the S&P 500, but I believe that that is kind of a fake price target increase because Goldman Sachs has already liquidated 25% of their entire equity portfolio. Now, Bank of America remains a lone bear in its house view of 1.9% on the 10-year Treasury yield by year end, up 55 basis points from today, and that would translate into a 15% drop in the S&P 500. Now, while that may not sound huge, considering the amount of margin leverage and negative gamma in the system, a 15% drop would certainly feel like a major crash to most margined market participants. Now, we already know that there is a massive wave of margin calls coming. It is direct from the DTCC. It does not get more cut and dry than this. When we come over here, we can see that there will be an upsurge in the volume of margin calls and an increase in the need for third-party custodians to keep safe collateral. This is exactly what the DTCC has said, and they are referring to basically positions that are over leveraged on these OTC derivatives. Now, who holds a lot of these derivatives? JP Morgan, Goldman Sachs, Citibank, and Bank of America. Goldman Sachs and Bank of America have already shown signs of them essentially wanting to sell off a lot of their positions, and Citibank is in that boat as well. JP Morgan has a slightly different view, and they haven't really come out with anything huge that refers to all of this debt in the market. Now, Bank of America is the only institution that has really come out and tried to basically pad their balance sheet or prepare to pad their balance sheet in order to basically survive the incoming, most likely market correction that we have on hand. Now, what they've done, we've gone over this, so we're only going to cover it quickly, that Bank of America files a shelf offering of $123 billion in debt in equity securities over time. So what this is looking like right here is that Bank of America sees that, one, they're wildly over-leveraged on the derivative side, and they're going to need a way to raise capital to get them through a major market downturn, correction, crash, whatever you want to call it. Now, bringing this back to AMC, in my opinion, this is incredibly bullish for the situation that we have on hand. We have all of these institutions wildly over-leveraged, the reverse repo market, going absolutely crazy. We know that margin calls are going to start ramping up in the beginning of September. The debt ceiling situation where we could see the credit rating downgrade of the United States coming in the beginning or end of October. So everything is kind of pointing to a significant sell-off and margin calls. So that is extremely bullish, in my opinion, for AMC. Now, again, if the market does sell off before we squeeze on AMC, it is entirely possible that AMC takes an absolute beating. But what I've tried to get across to you guys in the past is that even if the market starts to sell off, the shorts aggressively add to their positions, you have to realize that algorithms are really deeply involved with the market. If the price goes down to a certain level for AMC, if for some reason, again, we see that correction in the market and AMC ends up selling off with it, the algorithm eventually will switch to buy, and they are still going to have to cover all of those shorts. So I view that potential speculative situation as kind of the final boss. But again, there are so many other different factors that could kick off this squeeze. I'm just incredibly excited about what we have over the next couple of weeks, months, and quarters, that it really only makes sense to me to keep following AMC and to keep buying more. But again, nothing I say in these videos is financial advice. These are for educational and entertainment purposes only, and anything that I say in these videos is just my own opinion and what I am doing in my own portfolio. So that is going to conclude this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great weekend, and I'll see you guys in the next video.